Well, Patrick, we're in for a heck of a show today because we're going to talk about the triple T's of destruction, as I call it: Trump, Trudeau, and tariffs. We're also going to mix in a little interest rates on top of that. What else are we going to talk about?
Well, we have to look at what's happening in terms of rental supply. We've got growing rental supply, yet our immigration and our population is flat, and some would even consider it shrinking. And guess what? No surprise, the power of sales are increasing dramatically in Toronto / the GTA. That condo market continues to melt down and is only getting worse.
Ladies and gentlemen, welcome to episode number 57 of the Rain and In Show. You are in for a treat. It's going to be a wild ride today, so get ready.
Listen, folks, we want to grow this channel for you, and we need you to like, to subscribe, to comment, get those algorithms cranked up. JG, we have people watching, but they're not subscribing or they're not liking. We got to get the algorithms up so you can get some motion going in our YouTube channel. Help us out.
All right, Patrick, let's talk about the triple T's of destruction, I call it: Trump, Trudeau, and tariffs. Now we're gonna end with Trudeau because I know, actually, maybe we should start with Trudeau because I know that gets you all fired up. So actually, you know what? Let's start with Trudeau. What did you think about the Trudeau press conference, our fearless leader, non-leader, and his press conference? What did you think?
Well, when we look at all of it, at the end of the day, we continue to have to struggle with the incompetence of our NDP Liberal government and the negotiations. So some would argue that he did a great job. He says, well, 1.3 billion going to the border. He'd already made that commitment in December. So was he being really savvy? Did he actually give Trump what he'd already planned on doing, as in what Trudeau had already made a commitment to, but kind of took it off the table? We just don't know what Trudeau's goals really were, and we don't know what goes on behind the scenes. There's some that would argue the point that, hey, listen, we won that battle. We won that negotiation. Others are going, no, not so much. But we don't have the insights or the behind the scenes details of what really goes on. At the end of the day, we got a 30-day kind of reprieve from those tariffs going on. And my observation through it all, JG, is that we get all fired up. Canadians get all fired up about what Trump is doing to us. And then there's those that get fired up about Trudeau's incompetence, like me. But at the end of the day, it's a little bit of much ado about nothing. We got an extra 30 days. Where's this negotiation going? Everybody's freaking out. Ford panics, rips up his $100 million contract with Musk. Musk, comments in Twitter, oh, okay, like big deal. And truly, what's 100 million when you're on your way to $1 trillion in your business called X and Tesla, et cetera? So my point is that there's a lot of rhetoric, there's a lot of emotion behind it all. We have to break it down and say, what does it mean to us? And at the end of the day, right now, it means nothing. It's just a bunch of headlines, a bunch of rhetoric, a bunch of emotion with nothing getting done.
Now, Patrick, I know we're talking about interest rates next, but did you? I'm not sure if you've had a chance to get right into the monetary policy the Bank of Canada issued, and kind of they made some assumptions, some forecasts about what could happen if the tariffs do stay on, if they stay at 25%, and and it was kind of an interesting and fascinating read to see their forecast of where it could go. Not sure if you got into that report or not.
Well, I've looked at some of the things that are, some of the banks are talking about. BMO has made some forecasts and readjusted their forecasts a little bit just recently. And then ultimately, even when I look back at our conversation last time, I was looking at 2025, and I'm, at that time, I'm going, I don't know if we'll get another quarter point. I don't know if we're going to get much more than another 25 basis points in terms of a reduction. But having said all that, today, as we sit here, given what's going on with the U.S., potential tariffs, all the things that are happening, I think that BMO is saying that we're going to get a 25 basis point cut right through 2025 in each announcement. So that brings us down to like 2% or 1.5% again, some ridiculous number like that. Good news in some aspects, but in other aspects, not so good. And we are at risk of quantitative easing firing up again, which is going to flood more capital into the market, which is going to create inflation, and we go through that whole cycle again. Whether or not the QE will happen, they've definitely shut down quantitative. In other words, they've stopped quantitative tightening. So that means that the natural progression historically would be into some form of quantitative easing. I think it's a little premature to make that call, but it is definitely something that could happen. And I think we can't step over the fact that given tariffs, where that will potentially go, we're going to see inflation, which is going to force the Bank of Canada to bring rates down.
That's the problem, but that's the problem actually, Patrick, is the challenge with this, and we have. So they recently brought interest rates down. For those somebody watching this show, in case they don't know, interest rates came down a quarter point last week, Patrick. Which this is the first time we talk about it. So that's been good. Bond yields have taken a real nosedive. We'll talk about that in a second. The challenge is that we know tariffs tend to typically lead to inflation because the price of stuff goes up, right? And what's not helping us at all is that this is hammering the Canadian dollar. And as a result of it hammering the Canadian dollar, that's going to bring up inflation as well. And the Bank of Canada, and I actually watched their full announcement along with the Q&A, which is interesting because Tiff Macklem, and I know you're not a fan, but he got asked a really good question. And essentially it was this: if push comes to shove and you have a faltering economy because of tariffs and you have inflation, which is, both, like, that's the worst scenario, isn't it, Patrick? Essentially he's going to have to pick a direction. Do you cut interest rates in order to spur up the economy, or do you tighten up, do you increase interest rates in order to stop or to decrease inflation and to stop inflation? And he said if push comes to shove, their mandate is to maintain pricing. So they are going to side with the side of inflation versus the side of the economy. He was very clear about that. And even though I hate that, because that is what they're going to do. So if we end up in that very unfortunate situation, and I'm not saying we will, because there's a case for it not happening, but if we do, they will bring up interest rates, and that's going to hurt real estate more than it already has.
Yeah, it is an interesting scenario that's unfolding, and we'll start. All we can do is watch and see what happens. I think that, from a real estate investor or business investor point of view, I think that, it is about being proactive. So managing costs, making sure that you are capitalized. Liquidity is going to be something that all investors need to be aware of. We've talked about this for the past couple of years, which is to stay ahead of the game in terms of not being over leveraged, not getting caught being over leveraged. Now, that happened a lot in the condo market. We don't need to spend any time on that. Less so on the, kind of multifamily, as in rental world. But I have to say that I think the economy is going to continue to slow if we, in fact, see those tariffs on both sides of the equation. Then we've got the increase in carbon tax. The disposable income of our economy within our consumer driven economy is going to slow down. So there's some concerns for 2025. There's both a bit of optimism and a bit of like, I don't know what's going to go on. Like, certain sectors are getting hit. Others are going to do very, very well. So Tiff Macklem, again, we've said it before, it's, between a rock and a hard place. What are you going to do? You lower rates, you keep them the same, you even bump them up. They all have different effects, but none of them ultimately are good.
Yeah, it's interesting. It was a very interesting. Typically I watch parts of it, but this time I really dove into the whole thing because I was curious to see what they would say specifically about these tariffs. And don't forget, he did this before kind of it all unfolded. He did his release, I think it was Wednesday last week, and kind of the tariffs were still a maybe, and then they became a thing, and now they've been paused for 30 days and so on and so forth. But it's very interesting to see what's going to go on. What this will do, though, for sure, you can count on this in the real estate market, and I want to talk more about how this impacts the real estate market specifically. But what this will do, from my perspective, Patrick, is this is just another huge shot of uncertainty for investors. And even though we were already, the last week's episode that you and I did, or 2 weeks ago, we talked about how much uncertainty there was in the market. And I think we're coming to the bottom of that. But this just is another shot of uncertainty to extend that kind of bottom of the cycle movement. So that drives me crazy, but that's the reality of where we are. It does create phenomenal buying opportunities for those that do have a long-term view, but you got to be sophisticated right now. You got to be able to see beyond this baloney and beyond this bullshit, and that's not easy for people to do. I got to say, I mean, it's a struggle even for sophisticated investors like you and I, Patrick.
Oh, for sure. You can't help but look at it, and the emotion comes into play. What I find effective for me, and it's just I don't know if it's a hack, just a way of viewing the world, is you have to sit back and go, what will this be like in 3 years, 4 years, 5 years from now? Because what's happening right now. So, for example, we've got a government, or do we have a government? That's the question of the day. Is Carney, here's what I'm referring, Mark Carney, or Carney Carnage, which I think is more appropriate. The point is that we got this another non-elected politician having comments, having an opinion, actually representing us on mainstream media. And I'm going, who are you? Like, what? You're not even elected yet. Like, you're not even a liberal leader yet. So what the heck are you doing here? Anyways, that's a whole different conversation. But the point is back to your comment about uncertainty. We are right now, Canada feels to me like we're in limbo. And the reason is that we got a government that can't seem to get their shit together. Then as business owners, and many business owners and SMEs, and I'm talking even outside the real estate market, they don't know what's going on, because what is the final decisions going to be around tariffs, and what is that going to mean to them? And so here we sit. We need an election. We need decisions made around the tariffs. We need leadership and representation, and we don't have it. Danielle Smith seems to be the only one that knows how to negotiate a deal with Trump, yet to be seen. That's my view of it, what I've seen so far. And so, again, we sit in limbo. And how do you make a decision based on no guidance as actual, what are we going to do as a country? It's divided as usual, and it's getting more divided. We look at where we're going economically. And by the way, trying to understand the real impact of those tariffs, because the tariffs are on Americans. So in other words, they're paying more. We're going to retaliate, and then we're going to tax them. That's what a tariff is. And it's like, what the hell is going on with all of this, and how do we make business decisions? Like I say, real estate or not, how do we even make business decisions not knowing where we're going?
But I do think where this goes, Patrick, is there is, this isn't something that's, we've seen a lot between Canada and the US. This is like relatively in terms of like across the board tariff. Of course, there's tariffs on, over the years, there's been tariffs on softwood lumber. There's been tariffs on steel. There's been tariffs on a variety of kind of isolated industries. So this is like an across the board. So there's not really a playbook. I think there's a lot of people scratching their heads. Like, a lot of people typically look to history to guide their future decisions. And there's not a lot of history here to lean on for a lot of people. What I can tell you, though, and I find quite fascinating, is that we know what's with the real estate market. I think there's still people that are in for, and I don't know why people get behind this, but there's people that are still thinking, oh, there's more room for real estate to drop. There's no evidence that real estate has been dropping. I don't know where people are getting this concept that, oh, real estate's been coming down. Just look at the numbers. Real estate has not been coming down. Yes, condo prices in a particular segment of the market have been coming down, but real estate across the board, the real estate I own that I consistently get appraised all the time, my real estate's not worth less than it was, and I don't expect to go down at all. In fact, I think this is going to create some serious inflation in the real estate space, Patrick, because construction materials are going to go back up, right? We know that's going to happen. If these tariffs hit as hard as they could hit, construction materials are one of the first things going to be impacted. That's going to drive the price of building a property up. So, Patrick, one of the questions that I know investors are asking themselves, and rightfully so, I know it's a question I've been asking myself, and I've been doing a lot of research. This is what's going to happen to the real estate pricing. Let's just say real estate prices. And there's a school of thought out there that people think, well, real estate prices are going to fall. I really don't see that happening, Patrick. I really do not see prices falling. Now, are prices going to rise as much as they could have without these tariffs? No, I see kind of some sideways momentum here for a little bit because of these tariffs, and uncertainty typically creates some sideways motion, but I certainly don't see them falling. In fact, there's a real case for them increasing, especially over the medium term, let's call it, because as soon as these tariffs normalize, the first thing, if these tariffs hit, this is going to drive up the price of construction. There's no doubt about it. Price of construction is going to go back up and on. I've been saying on this show now for how long, Patrick? 12 months, 18 months. I've been talking about how I'm able to bring the price of construction down in the last 18 months. That's going to be over if these tariffs hit. All this stuff is going to go up in price, and the price of construction is going to go straight up. And if you combine that with the other problem, is in the last 18 months, building permits are down to nothing. So the supply of construction and the supply of housing is way down, especially in that single family cohort, as we've been talking. I see those two things as a huge incentive for the price of real estate to go up into the future, not down. So this concept that real estate's going to fall through the floor and that the price of real estate is going to come down, I don't buy that for a second, Patrick.
Yeah, I think we have to be, go back to what the fundamentals of all the things that we've talked about, over the past 30 years of doing real estate education and economic research. And the fundamental is that we have to look at property type, and then we have to look at regions. So to your point, I agree. And actually the data supports it. When we look at house prices over the past 12 months coming to the end of December, depending on what property type you're looking at, real estate prices have not come down. I mean, there was from the peak, but when we look at certain property types, again, in that single family space, they haven't come down. Again, I'm not even bother talking about the condo market because it's a different beast. The one concern that I have, and I've expressed it many times, I'm watching it unfold, I'll say it again, is that when we look into purpose-built multifamily rentals, that market, because of the MLI Select CMHC program, that has been on a tear. So we've got a very likely scenario where you're going to have regions that are overbuilt. And we're already starting to see rents come down and vacancies go up. It's not dramatic yet, but as I've talked to some very, very accomplished investors and owning quite large portfolios of multifamily units, they're saying they're having more work to do in terms of getting stuff rented. They're having more challenges in terms of appealing to the tenant, and there are fewer people applying. So all to say things are slowing down in that rental market. Part of that is driven by the immigration changes that have happened. And the other part of it is that there's an overbuilt scenario that's starting to unfold that we have to pay attention to.
Yeah, I think that's a very interesting point, Patrick. Now let's talk interest rates for a second. So last week, Bank of Canada decreases interest rates. Fantastic. Last week, Patrick, and sorry, 2 weeks ago, you and I were saying you predicted the quarter point drop. Fantastic. I was hoping for a half point drop. Didn't get it. Now your prediction.
Let's face it, JG.
I know. Listen, buddy, I that's where I operate. That's those rose-colored glasses. That's where I operate. That's perfect for me. So, but you were saying quarter point last week, which you got, and then you're saying quarter point in March, and essentially that was pretty much consensus. By the way, you were with the banks and most people, which was quarter point, and then essentially take a pause, maybe nothing for the rest of the year. Now what's happening? Now these tariffs. You're saying BMO has come up with some, because there's a new conundrum developing for real estate investors. So far in the last 12 months, it's been very clear for investors. If you're going to get into a mortgage, pretty much you should go with variable, and then you should, or go with a really short, 1 year, maybe a 1 year fixed or something, but don't be locking in for 5 years. There's not time to be locking in for 5 years. But I see investors now coming up against a real conundrum, because if inflation hits because of tariffs, I'm telling you, the Bank of Canada is going to start raising interest rates, not dropping interest rates. That's what they're saying. They said that very clearly last week. So it's possible that we're going to have a reversal. Now, you're saying BMO is not saying that, but it's going to be a new conundrum for investors to solve.
It's just a changing market. So this is why part of the reason that everything's in limbo, because nobody really knows. And certainly the politicians don't know. The Bank of Canada doesn't know. There is certainly just a wait and see that is happening, and it's unfolding. And that's what we have to live with right now. So if you develop a thesis and decide what you're going to do, then you have to work backwards from what you see into the future. And right now, most are sitting on the sidelines waiting for decisions to get made, waiting for a path to be, or some form of a path to that they can look down and okay, that's where things are heading. And right now, there's so much that's open up in the air that we literally don't know. I think that the uncertainty in the market overall, and if you look at what is potentially happening in the bond yields, we're going to see fixed rates potentially come down as we've seen the volatility in these in the bond yields. JG, they've come off of what was really high even just a couple of weeks ago to under 3% again. And so you go, wow. And I think that literally by the time this comes, like in the next couple of days, literally, I think we can see fixed rates come down a bit.
It's interesting, Patrick. I was going to ask you this question about how long it takes from the time bond yields drop, how long it takes, because sometimes the banks don't give up those discounts, right? Sometimes they absorb those discounts and it creates additional margin for them for a period of time. Sometimes they kind of hold the line for 30 days, 60 days, 90 days kind of thing. But are you thinking that this recent drop from 3.25 to 2.75 is a huge drop in the 5-year bond yields? I mean, typically this sucker is like straight, right? Like it hovers like a couple bips here, a couple bips there. These are huge swings for 5-year government bonds.
I think that, the way, and, as I kind of listen to some of the experts that I listen to, there's a general consensus that, fixed rates could come down and hit that 3.99, 4.15. That actually could be the fixed rate band that we have the opportunity to tap into. I think that anybody that is renewing a mortgage would, you got to be what you're comfortable with. I would go variable personally, and I think that the chances of variable going down are now greater than going up, which is to your point, and even greater than staying flat. That's where I'm looking at it. But again, right now I'm in a good position. I don't have to renew anything coming up, so I'm just being, observing what's going on. I had a bunch of variables, and variables have come down, so that gave me some reprieve, like many. Again, we don't know what rates are going to do because there's still decisions that have not been made.
Yeah, that's a good point. The other thing this is a bit of a pro tip for real estate investors that are watching. I guess some people don't know this, but if you do go variable, you can lock into a fix pretty much anytime you want because the banks love that. So a lot of people get like, what do I do? What do I do? Especially in a time like this, if you're thinking like, okay, I think we still have ways to go down, but then there might be some risk of it going back up. Ride the wave on the way down to variable, then lock in when you think you're at the bottom or close to the bottom. And that's the other thing. Don't try to time the bottom, Patrick. This is a recipe for disaster to try to get the perfect interest rate. If you're a real estate investor, when your cash flow is in a really good spot and you think you're in a good place and you would rather trade the peace of mind for that extra $30 a month in cash flow, lock it in and sleep well at night. Like there's nothing wrong with that either, Patrick.
Yeah, you make those decisions and it's all about forming that thesis. I think there's two is that, we have to consider that when we look into the future about what interest rates are going to do, the bank's job is to lend money. Now, they're also in a bit of a rock and a hard place position. We got a slowing economy. We have parts of the real estate market that is coming apart, and they want to mitigate risk. So they've upped their reserves, but mortgage renewals will do really well with the banks. In other words, we got a lot of renewals coming up, 25, 26, but they need to do also new lending. They're going to buy some time because of all the renewals, and that's good news for the banks in terms of their lending. But the new lending is coming way down. So depending on the bank, they're going to have different views of what their risk exposure is. But you're going to see banks get a little bit competitive if people don't start borrowing money. They need people to borrow.
We've already kind of been seeing that a little bit, Patrick. I've been saying for some time now on various speaking engagements you and I do, outside of this show. And we've been talking about some of these lenders are getting quite creative and putting together programs to get some of this money to work. And, I've been seeing it now for probably 3-4 months. So it's interesting. We'll see where that goes. Again, this uncertainty doesn't help that. with these tariffs and stuff, but hopefully that plays through relatively quickly. Before we move on to lending and kind of because you got a great chart here on a snapshot between kind of Q4 2019 to Q4 2024 in terms of various lending. Before we get to that, Patrick, tell me right now, I would say we're at the height of uncertainty. I'll say pretty damn close to the height of uncertainty. How long do you think before there's a meaningful change in uncertainty and it comes a little bit back down to normal? Do you think it's 30 days, 60 days, a year? How long do you think that investors have to be prepared to kind of weather this uncertainty storm from your perspective?
It's a good question, but it's hard to say. Certainly we have to wait to see what happens over the next 30 days and, what Trump's going to do in terms of tariffs and how we're going to respond to those tariffs. So there's a little bit of uncertainty in that world. Some people may profess to know what Trump is going to do or what the Canadian government is going to do or our lack of Canadian government, what they're going to do. The point is, it's just really hard to say. I think that we have to see what happens and what plays out over the next quarter. But having said that, there are certain markets in the world of real estate. If you're a real estate investor, JG, and you can understand the devaluation of our currency, I'm going to keep going back to that. Our fiat currencies, our dollars, are losing buying power like every month right now. What's going on? We look at gold, and gold right now, like when I open up and say, when I open up
When you open your, what you mean when you open your vault there at home, like your big vault, you just like you have like a vault like the banks, like you have one of those.
Settle down. When I open my desktop in the morning, one of the first things I do is look at gold prices, because gold prices really are a snapshot of what the emotional sentiment is of a market, because people go to safety. Gold just crested $4,000. It actually broke $4,100 Canadian, $2,860 US. Record all-time highs gold is hitting. People are nervous. They go to gold. So my point is that as real estate investors, we have to go back to one fundamental. Our currency is being devalued. We need to own hard assets. If some of those hard assets that you own are precious metals, great. If Bitcoin is one of those things that you want to own, that's awesome. But real estate remains a hard asset, a store of value. And I don't know, I'll keep saying that until people understand, and hopefully they get it. Buy in the right regions, buy the right property type, buy for cash flow, and hang on. Because JG, right now, between you and I, close your eyes, look forward 5 years, and what do you got? You've got a real estate market that has recovered back into full swing. We as a country are operating like we have to be optimistic. We have to look into the future. We can't be caught up in what's going to happen in the next 90 days.
Yes.
What we have to look at is go, okay, well, because I'm looking, and I was doing a little bit of research on Windsor, by the way. Just out of curiosity, I kind of wandered down a rabbit hole. And right now, aside from the fact that unemployment's quite high in Windsor, the housing market remains quite strong. And, there is some opportunity in Windsor. It's just early research, I guess, but I would take a hard look at Windsor, by the way. I mean, you're based out of Peterborough, that area like the back of your hand. Are you shutting down? Or are you going, holy cow, this whole area is not looking good, I'm getting out?
We're doubling down. We're doubling down. I've done more real estate in the last 3 months than than before. So it's phenomenal. I 100% agree with you, Patrick. And you've often said, and I appreciate the tagline because it really sticks with me. And this is a perfect time to use it, which is when in doubt, zoom out. And what that means is take a longer, open up the aperture and take a longer timeline, a view of everything. And this is exactly, if investors are freaking out, that's what you need to do. Start asking yourself the question of, what does it look like in 3 years? What does it look like in 5 years? What does it look like in 10 years? Because if you're doing real estate right, that's the timeline you should be looking at, not what the hell, what matters, in the next 30 days. I mean, there's some tactical things that are, the reality of real estate if you're refinancing, and there's some tactical decisions you might have to make. But in general, Patrick, zoom out and look at the long-term picture.
Well, we keep hitting on this point, but the game changed actually back in 2008. and that was when through the GFC. My point is that then it really ramped up in 2020. The reason I'm bringing this to the forefront is that we have to understand the game has changed, by the way, because monetary policies have changed. And so we have to look through a different filter and a different lens. So you think that, okay, well, real estate's going to crash. Well, no, actually, it isn't going to crash. And the reason it's not going to crash, one of the reasons it's not going to crash, is because it isn't about our real estate prices going up. It is about our fiat currencies, our currency being devalued. So it has the only direction it will ultimately go is to increase. And it'll be, it's an illusion,
Yeah.
it is an illusion, but ultimately we need that buying power. And I've shared before is that over the past 100 years, we've literally lost 95% of our buying power. What you bought for $100 100 years ago is now worth $5.32. So look into the future and you start to realize that you need to get your capital into a hard asset, and real estate is still the way to go.
Yeah, it's interesting, Patrick, that you mentioned that because, and I would advise people, because you make that statement, this isn't about real estate appreciating, it's about the devaluation of our currency. And if somebody doesn't know what that is, you should go down the rabbit hole. And the beauty of it is, number one, it's easier to go down this rabbit hole than ever before, which is just open up ChatGPT and start having the conversation with it and have it explain to you what that means. Because Patrick, even though you say it like that, it's a big concept to understand. Like it's hard to wrap your mind around it unless you've really trained yourself that way. And, it didn't happen for you overnight, didn't happen for me overnight. So it's important for people to play with it and explore the concept so they truly understand.
It is hard to wrap your mind around. There's no question about that. And the other side of this, JG, is it's a global phenomena. This is not just Canada. It is a global phenomena that was driven by, first and foremost, the GFC, where they started to change the whole monetary policy. Quantitative easing became a thing. And now here we are 5 years after 2020 going, holy cow, they printed all this money. It actually created the inflation, and now we are dealing with that fallout. But that policy, that way of being, isn't going to change. And when we look at the Canadian dollar, compared, everything gets compared, by the way, is measured against the US dollar. All currencies are measured against the US dollar. So we're going to, arguably we're at 68, 69 cents. Some are calling for 64 cents. Investors need to get out of the emotion of what's happening in real estate today and look into the future. That's the guidance that we have to give today.
And it didn't start, Patrick, in the 2008 GFC was part of it, but it actually started in the 70s when they got away from the gold standard. That's when it actually got started.
100%.
Okay, talk to me about this chart, Patrick. Let's get into the lending portfolio 5-year comparison of 2019 to 2024. I think this is a very fascinating chart.
Well, I think we just have to break it down and look at where the money from the banks are going and just how much they're invested in real estate. Some of the banks, and they all have different views of the world, right? Where their lending policies have taken them, what they've got tied up. And, all of them, by any stretch, are actually got a lot of dollars in the real estate market. That is actually what Canada's economy, it's a huge part of Canada's economy. Sadly, it's one of the only things. We keep going on talking about productivity, but the real estate market is problematic right now. The banks are nervous about it, but having said that, the banks are still waiting for buyers. Forget about real estate investors. They're looking for home buyers to step up, and that's still not happening. So they have to get lending. They're going to be creative around it, but that shows a risk profile of the banks, really, when you look at where their money is.
Yeah, and as you can see, every single one of them, Patrick, as you mentioned, is up from RBC at 54%, 36% for TD. Scotia's up 28%, BMO's up 51%. They have a lot more dollars at work in 2024 than they do in 2019. But I don't think this chart is not like they haven't put the dollar to parity, meaning like this is 2024 dollars versus 2019 dollars, which are different dollars, if you know what I mean. Back to the devaluation of currency. So very interesting. Let's talk unemployment real quick. We'll touch on a couple things here, Patrick, but the unemployment is one of those, back to the uncertainty. Our unemployment rate has been going up, pretty steadily across the country over the last, like in general, over the last, say, 12, 18 months. And now these tariffs definitely put all of that into question, meaning, is it going to get much worse? Time will tell. But what does this chart show us?
Well, the one thing about unemployment, and we've talked about it pretty much every episode, where we see it growing, and particularly in different regions. And Toronto is, I think they crested 10% unemployment, and because so much of it is based on the housing market, so that scenario is going to get worse. I think the big concern with tariffs, for example, is the automotive industry. Ontario, I think Ontario is going to carry the brunt of whatever they decide to do with tariffs, and it's a big deal. And I think that we are at risk in that regard with Ontario. And we've said before, is Ontario is going to be really the kind of the hub of what drives what's happening economically, just because of population. They are going to feel the biggest effects of it, especially in the manufacturing.
I don't know, dude. I mean, obviously Ontario is the biggest economy in Canada, but what happens to? I mean, if you want to go down the doom and gloom side, I'm happy to go there too. But what happens to Alberta if gas, oil, gas, all this stuff? Look at Manitoba, look at Saskatchewan if they go down Agriculture Road. Look at BC if they go down Softwood Lumber Road. I mean, those are big parts of those economy that all gets hit really hard with tariffs.
Well, but let's not. Yeah, yes, 100%. And so there's lots of risk there. But what I'm saying around what's happening in Ontario, because of the size of the population and how much housing drove it, and that slowdown in that condo market as one example, and then the risks in the manufacturing world, the general lack of productivity, which we've talked about a lot. My point is this: is that Ontario affects the whole country. No different than Alberta affects the oil and gas of the whole country. Ontario affects the whole country economically, because there is a lot of work that is being driven by what happens in Ontario right across the country. So it's only to say that where everything, all parts of Canada, lesser degree to, let's say, Saskatchewan, Manitoba, but certainly Alberta and BC are at the effects of a significant downturn in the economy in Ontario. So we have to pay attention to all aspects of it. It's not to say that Ontario is going to suffer and nobody else is. It's going to, but I think it's going to be the epicenter of the suffering.
Yeah, and if we come back to the effect on real estate, especially the pricing of real estate and the rental market too. We're going to talk about the rental market next, but we talk about the price of real estate. It's interesting because depending on how the tariffs reverberate through, if it happens, and there's still a big if. My position from the get-go, Patrick, is that this wasn't going to happen. I didn't think the tariffs, it got way too close for my comfort. I thought it would get stopped before it did. But from the beginning, I thought this is just a tactic for him to negotiate. Now, he definitely went to the 11th hour. He called my bluff on that one. We got out of it for 30 days, but we'll see. But if they do reverberate and they go through, it's interesting because if you look at like where Ontario's real estate is compared to where Alberta's real estate is, Alberta's been on an absolute tear. Alberta is definitely, from the price of real estate, is towards the top of its cycle, not towards the bottom. Ontario's already at its bottom. So if there's any real estate market that's going to come off its highs, so to speak, it would be Alberta if these tariffs reverberate through the economy and it has a negative impact. So I think that's interesting. Plus, you've been kind of sounding the overbuilding bell in Alberta for some time. So interesting. It's going to be a fun ride.
Well, I'm going to say again is that we have to look and break it down. I don't think Alberta in general is going to feel the slowdown in real estate as much as, for example, regional. Calgary right now, to me, is into overbuilt territory. And I think I'm looking down 2 years down the road and 3 years down the road. I'm not looking at what's happening today. I'm looking where the trend is going into the future. So when we look at what's happening in that Calgary market, it's been through its cycle. It may get a little bit of a reprieve and kind of hold steady and blip up, but it's getting softer. You can start to see it in the data. And I'm just looking at data. I mean, at the end of the day, if you talk to some specific realtors or brokers in the market called Calgary, they're going, no, it's all really good. I'm only talking from an investor perspective, not from a home buyer perspective. And I think that we need to be really clear on. And that is that Calgary is into that market, that you got to be really cautious of what you're doing in that Calgary market, what you're investing in, and make sure that you are buying for cash flow and that you know who your demographic is. And I'll only end with, kind of wrap a bow around all of this conversation, is that there are great deals to be had out there for investors in the world of real estate. You don't have to rush. You just have to be prepared. You can't steal in slow motion. So you want to make sure your financing is all put together so that you can take advantage of the deals as they show up. And mostly we have to realize that competition in that market is going to increase. So there's going to be more options for tenants, which means that us as rental housing providers, we got to up our game. We got to make sure we're maintained. We got to make sure we're current. We got to do great marketing. We got to be really good at managing our properties to attract our tenants.
You got to be a better property manager today. And we're out, and we've been out actually for probably 6 months. We've been out of the Goldilocks stage of like any crappy property manager could do a good job. We're past that. You got to be good now. You got to be better than the others in order to get the top rents, in order to keep the clients happy, in order to get those top paying clients. You got to be better than everybody else. And if you work with great, if you learn the stuff, if you go to, Rain, for example, and you learn how to manage properties and you're on top of your game, you're going to do well. If you work with great companies like Visture, you're going to do well. But, that Goldilocks period, Patrick, I agree 100% with you, because I'm hearing a lot of, stories now where people have all these horrible experiences with tenants and stuff like that. And I'm like, why are you going through all of this pain? That could be avoided if you knew how to manage properties properly. And I'm seeing more and more of that nowadays in this market, Patrick.
Well, let's just shine a light on the obvious. In a boom cycle, we've said it many times, everybody looks like a genius. So think about it, ultra low rates, record immigration. We had refugees coming into the country from Ukraine. All of this coming, students coming in, it didn't take a lot to look really smart in the real estate market. We've talked about that many times. I'll say it again, is that we as rental housing providers are going into a competitive market, and we have to be prepared to up our game in a cycle that isn't, throw something up against the wall, because it will stick. We're beyond that. We're past
that. And those crappy properties, and we tell this to owners all the time, this is really important. Those crappy properties that you haven't been maintaining, that you haven't been investing into, that you haven't been painting and replacing kitchens and changing the floors and keeping them up to snuff, this is where those suffer. This is where those stay empty for 3 months, 4 months, 5 months. This is where, instead of making $2,000 a month, you're now renting it for $1,800 a month, and you're getting a huge price discount in your mind. It's not that the market has come down, Patrick, as we talk about rental. It's not the market has come down necessarily. It's that there's just more competition. So you have to be better. You should have been investing in your property this whole time to keep it up to snuff, but you chose not to. That was your decision. That's a shitty move as an investor. That's not the market's fault. That's the investor's fault.
But they'll blame the market.
I'm fired up. I told you I was fired up today, Patrick.
They'll blame the market. Anyway.
Okay, let's talk rental. What is happening in the rental market? Because one of the things that tariffs, because I want to connect this, I want you to speak to what's happening in the rental market, Patrick, because I know we'll speak that in a second. But one of the things, tariffs, one of the natural things that will happen with tariffs, depending on what happens to the economy, is overwhelmingly the odds are rents go up in this environment, because interest rates will eventually go up, the cost of construction will go up, the price of real estate will go up, and all of that will lead to higher rents. So the odds are this will push rents up as we go forward. Not this month, not next month, but over time.
This year is going to be a soft year for rents, and that comes from the supply, the lack of immigration, the uncertainty, and there's something that we have to consider, and that is there's a lot of fear with people about losing their jobs. So they don't want to move. They don't want to take the chance of getting caught, having to pay more rent. They may want a nicer place, but they're going, no, we better hedge our bet. Let's just stay where we are. So there's not a lot of movement going on as well. And so And then, of course, in Ontario and British Columbia, to the lesser degree, you've got some real challenges when it comes to the cost of building. And then you've got the challenges of landlord tenant board, and what they're doing. And I mean, it's pretty messy. So I think you're going to continue to see rents come down and be soft. I don't even want to say they're going to drop dramatically. I think some places they will, but they're going to be very, very soft going forward. And part of that's just the supply that's out there. I mean, let's face it, JG, when you look at the condo market in Toronto, just use that as an example, is those rents are coming way down because there's so much supply out there. And then, of course, you've got unemployment increasing. And if people aren't working and there's lots of supply out there, that is a formula for rents getting soft and actually prices coming down.
I want to speak to this on a couple different fronts, Patrick. 'Cause I think you're bang on. I think number one, the charts, which we show a lot of, and we show a lot, the charts won't look great in 2025, meaning it will appear like rents are coming down. Does that mean that a good landlord with a really nice apartment in a good location is going to have softening rents? No, that's not at all what it means. Not in my markets, anyways. I can guarantee that, Patrick. But the charts will look softer because of the inventory you're talking about, Patrick. And overall, because these charts look at a massive aggregate of data, we definitely won't be gaining like we have been. Rents won't be going up 10%, 12%, 13%. That's for sure. But I think the average investor that's out there that has a great place and a great location, that has been maintaining and investing in their place, they could just calm down, because it doesn't mean that your rents are going to go from 2,100 to 1,800. Just calm down. That's not going to happen. If you're managing your place properly, you're going to be able to do really, really well. But the charts will definitely appear soft, and the bad inventory is going to get flushed out of the market. That I can guarantee, which is the crappy landlords are going to have a harder time renting their crappy places. And so they deserve that.
And that's not rocket science. That's just a normal cycle. We've seen it many times over the past 30 years that we've been playing in the real estate market.
Yeah, for sure. But you can see from these charts, Patrick, I mean, the rental housing starts are up quite dramatically. I mean, we are building, and it's funny because I remember you and I being on stage in like 2014, 2015, 2016, and we saw the trend changing. I actually remember when some announcements came out, I think it was in 2016, 2017, that really kind of painted the picture of, we're going to be pushing, the CMHC is going to be pushing apartments, and we're really going to go down the renter nation. And I remember like the moment that happened, and now you're starting to really see that in the charts. I mean, just look at this from like 2016, where the housing starts were like 30,000. Now we're up to housing starts of the rental housing starts are above 80,000, soon going to be 90,000. That's a tripling. Like, that's huge.
Well, you know something? Trump says, drill, baby, drill. We said, build, baby, build, because we got immigration coming in and it's never going to stop. And listen, this goes back to guidance we receive from our friendly government and our banks, et cetera, which is we need to provide housing because immigration is an important part of what we're doing and what we're going to continue doing. Everybody jumps on board with that initiative. And then in classic government form, they pull the rug from under everybody's feet, shut down immigration because they're feeling pressure. It's kind of the normal cycle that goes on.
Now, vacancy rates, Patrick, that's another thing. Vacancy rates are going to go up. We're already seeing it in some markets. We got a chart here of Kitchener, Cambridge, Waterloo. And I think a lot of investors track this number, as they should. I don't think it's a great indicator, though, Patrick, because this is, again, across all inventory. And most of the numbers that make it in here are condos and large multifamilies. The average, single family, duplex, triplex, garden suite, fourplex, that's not a big part of these charts. Most of this is large multifamily and condos. That makes up the bulk of this inventory. And for sure, as you indicated, the vacancy is up, especially in Ontario because of all the condos.
Well, there's a couple things around it too, which is, when we look at vacancy rates and we normalize, let's say 1.5% vacancy or 2% vacancy. I mean, those are ultra low vacancies and they're not normal. So when we go to 3.5 or 4%, even 5%, 5% is painful, no doubt about it. Very competitive market, but 3.5 is kind of where, it's pretty normal burn and churn. When people are moving, they're coming, they're going, they're changing jobs, they're changing relationships, they're moving out of the country or into the country. So is it really bad, or is it just kind of coming back to where is pretty normal?
Well, and I think you're actually making a very good point, Patrick. And I'll tell you how this shows up in the market. And we've been seeing this, but how this increased vacancy, how it shows up in the market is choices. Renters have choices. And as a result, how you treat the renters, how you respond to their ad, how they respond to you, that interaction, all of that matters. It didn't matter as much, Patrick, a year ago, 2 years ago, because what would happen is they didn't have much choice. So they would be willing to accept someone who didn't respond to their text message for 24 hours. Like, yeah, I'll get back to you next week and I'll show it to you in 2 weeks from now. You can't do that right now. As a real estate investor, as a landlord, if you have a tenant who's interested in seeing your place, you better be scheduling that showing that day or that evening, or they're on to the next one. And I have seen that firsthand, Patrick, where we've had to actually rejig our leasing process in order to get people through faster because we have so many rentals that we manage. As a result, sometimes it takes too long to get to a tenant, and they were just moving on. And it wasn't their fault, it was our fault. We had to change to meet the demands of the market, and that's what a good investor does.
Well, it's also what happens when people have options, right? They may beg and plead when there's no options, but once they start to have options, okay, we're moving on.
Let's talk power of sale, Patrick. It looks like power of sales are up. I believe this chart says 174% more than last January if we compare like January this year to January last year.
Yeah, I mean, we're stating the obvious that we've talked about many, many times, and it's going to get worse before it gets better. This is all primarily in the pre-construction world of condo market. That's not to say that there isn't some housing, home buyers that got in over their head and then had to, whether they lost a job or whether they had to sell, they bought at the peak, then they decided they needed to get out for whatever reason. So there's all sorts of things that are going on in that, but that's primarily driven by the pre-construction condo market, and it will definitely get worse before it gets better.
And TREB is the Toronto Real Estate Board. So as a result, this is like you said, it's highly influenced by Toronto. But unfortunately, some investors, they see these headlines and they freak out. Listen, if you're this is only relevant to TREB. This is in this particular case, this particular headline. So people can't be swayed by the headlines, Patrick. But there's definitely some turmoil in the market. We talked about that, and even good old Alberta, Patrick, is definitely tightening its belt. Let's say.
Well, there's the fear factor, and again, the divergence in incomes. The rich get richer, the poor get poorer. This goes back to the division that we have between the middle / upper middle, or even the wealthy, and then the lower 40% or even 60% of the market, depends on how you want to do the math, where they're afraid of losing their job. The cost of living has gotten way out of hand. And so a lot of dynamics are changing. And so, again, we look at what's happening in terms of a slowdown in Alberta, and costs are rising. Unemployment is kind of stable, but there's lots of fear.
All right, Patrick, as we wrap up this show here, what do you think as the kind of top 3 things real estate investors should really be focused on as we are in the kind of height of uncertainty right now? And I don't see that uncertainty going away for at least 90 days, 3 months, maybe even 6 months. I don't think it's going away until we have a new elected government and we get through these tariffs, and then we can get back to some level of normalcy here. That's what I'm thinking for now. And I think that's going to take 3, maybe even up to 6 months. What should investors be doing? Top 3 things. Go.
Yeah. So I think from investors' point of view, first and foremost, make the commitment to put your capital to work. Get prepared financially. So sit down with your broker, know where your money is, know where it's going. Another part of that equation, you don't have to hurry. That's the other side of the equation. Work with somebody, look for those deals, and be prepared to write lowball offers. Find the motivated vendors. That's the key to all of this right now, because they're out there. Buy for cash flow. Pay attention to what it is you're buying, and know who your end user is going to be. Who is the demographic that you want to appeal to? And then you can make some decisions based on that. I think the other key thing in all of this, JG, is we have to zoom out. You cannot get caught in the emotion and the rhetoric of what's happening with the US, Canada, tariffs, Trump, Trudeau, government, no government. I get it. I see it every day. But if we look 5 years down the road, 3 years down the road, 10 years down the road, you have to have a vision for where you see the economy going. And I remain very bullish on what is happening with Canada's real estate market and economy overall when I look 3 and 5 years down the road.
In fact, Patrick, I'll take that one step further. And I think that these tariffs and this recent round of, let's call it, negotiations with Trump, I think it's been a great wake up call, in fact, for a lot of people. I think people are like, listen, we have got to get, and I think Polyev put out a fantastic video about how much just trading within our country and taking down some of the trade barriers between provinces, which, by the way, you and I know very, very well, because I can't even buy wine from British Columbia, which, as you know, I've tried before many times. I mean, how stupid is that? And Polyev put out a great video. I don't know how much teeth it's got to it, but there's some economists that are saying there's like 7.9% GDP growth within our country if we eliminate the trade barriers within our provinces. That is fascinating. So I think this has been a great wake-up call. And I think that's exactly what we need to do, is look inward instead of looking outward. And I think that my advice for investors is to do two things at the same time, which is very, very difficult. But you got to have your head in the clouds and you got to look really far out, 5 years, 10 years, 15 years. And then you got to put your nose in the dirt, to the grindstone, and stop looking at all the news and all the other shit that's going on and get to work, because the seeds you plant today are going to bear incredible fruit in 5 years, 10 years, 15 years. And all of this uncertainty, what it really does is robs people of them taking action. And as a result, they do nothing. And in 5 years, they're in the same place they were 5 years ago, except their money's worth a whole lot less and their currency's been devalued.
Yeah, I think I want to just riff off one, you make some really good points, and I agree. And one of the things that I've been shut down for years around is just how much Canada, each province is like its separate country sometimes. It's like, how can you have these kind of trade restrictions between provinces? Nonsensical. Anyways, long story short around all of this is that we look into the future, and now the realization, do you know what I think this shines a huge light on? Is the fact that Canada as a country is not particularly diversified anymore, and have not gone out of their way to diversify beyond the client called the USA. This goes back to a number of the things that Trudeau shut down in his decision-making process, like, there's not a business case for natural gas to Germany. I mean, one of the biggest ball drops ever. And the point is that as we get a new government, I think we're going to start to see, okay, we need to get some other countries to do business with us so that we aren't so dependent on the U.S. I mean, we'll always be very dependent on the U.S. I'm not under any illusion that they're still not going to be our biggest trading partners, but we also have to diversify and have more client base, more and other countries that we can supply our commodities to, which we still haven't done.
Grow, baby, grow. It's time.
It's time.
All right, ladies and gentlemen, that was episode number 57 of Rein It In. Hopefully you've enjoyed it. Don't forget to like and subscribe. And Patrick, thanks for being here today.
Thanks, JG. If you enjoyed this episode and you want to hear more of what JG and I have got, check out our last episode. It was epic.